Everyone knows that compound interest is considered to be the eighth wonder of the world. But if you've had exposure to the real estate industry over the last few years, then you've probably heard of the ninth wonder of the world, also known as cost segregation. This tax planning strategy has gained a lot of popularity recently and is helping real estate investors turn single cap rate returns into tax advantage doubles. So, what is cost segregation and how can you use it to maximize your real estate income? Cost segregation is a way to depreciate different aspects of a building on different schedules. Now, the traditional method of depreciation is to separate the purchase price of an asset into the building value and the land value and depreciate the building value using MACRs since you can't depreciate land. MACRs stands for the Modified Accelerated Cost Recovery System, and for residential assets, it is over 27 and a half years, and commercial assets, it is over 39 years as long as that asset was placed into service after May 13th, 1993. Here are the tables from the IRS, and as you can see, depending on the period that the asset is put into service, which simply means when it is ready to be used for your intended purpose, you can capture slightly different amounts of depreciation, but it's relatively consistent over the entire term of the amortization, and it's somewhat similar to straight line. Now, with cost segregation, you're able to separate that building out even further into the price of the various aspects inside of the building. So there are two ways to do this. There's a more simple one, which is done with a basic accountant or even by an asset owner themselves, where you're going to go through and separate out the flooring, lighting fixtures, bathroom accessories, etc., to be depreciated on accelerated schedules. Then there's also a more intensive one, which is going to require engineers and probably cost a couple $1,000s to be completed. But you're going to be separating out the price of the plumbing systems, the HVAC, electrical wiring, elevators, things like that. Now, what one you use is, of course, going to depend on the asset and your budget, but typically you are going to use one of the more intensive studies for large multifamily, industrial, or retail assets. Now, once you single out all of the various aspects of these buildings, you can front load the depreciation to these elements on their respective depreciation schedules. So as you can see from this table, there is 3-year, 5-year, 7-year, 10-year, and 15-year property. And instead of depreciating these over the 27 and a half or 39 years that you would have had to if you had left them in the building value, you're able to use the 150% and 200% declining balance methods to front load this depreciation in the first few years. So what is the 200% declining balance method? So let's take an example with an asset worth $110,000 with a $10,000 salvage value and 10-year useful life. Using straight line depreciation, our basis is simply going to be our cost minus our salvage, or $100,000. Our rate will be 1 divided by our useful life, or 10% a year, which will of course give us $10,000 in depreciation annually, or $1,000 marginally if you're in the 10% tax rate, to keep it simple. Year 2, of course, our basis is going to be decreased by $10,000, but the rate doesn't really matter because we've already established that we are taking $10,000 in depreciation annually over the life of this asset. So as we go down to year 11, you can see that we no longer have any value on our books because we depreciated all of it in the final year of its useful life, leaving us only with the salvage value. Now, the double declining method instead uses the entire book value of the asset as its depreciation basis. And it's called the double declining, or 200%, because you take double the depreciation that you would have using straight line, which means we'll be taking 20% in this case. So our depreciation in year 1 is going to be $22,000, or at that same 10% marginal tax rate, we will receive $2,200 in savings. Now, in year 2, our basis will decrease to $88,000, but we are still taking the 20% depreciation expense, leaving us with $17,600 of depreciation in year 2. So how does this play out? Well, as we go all the way down to year 11, you can see that in year 11, our cost basis is $11,811. We are trying to take this 20% depreciation expense, but we are unable to because our salvage value is only $10,000, which means that in year 11, our actual depreciation is only going to be $1,811. Now, as you can see, you're really just front loading the depreciation to get those much higher expenses in the early years. But as you go on in year 5, you can see that you're actually capturing less of an expense. However, you can utilize this additional cash flow in the short term to generate other cash flows from other investments to further minimize your tax liability as time goes on. So now that we've covered what cost segregation is and how exactly these accelerated schedules work, let's look at an example of how it could impact you. So for the sake of this example, we're going to use straight line depreciation. And like I mentioned earlier, Macros is very similar to straight line. This is just going to make it easier to understand. So let's say we have a $1 million building. Let's separate into $200,000 land and $800,000 for the building. We're not doing a seg. We're going to leave this blank for now. Now, because it is a commercial asset, we're going to depreciate this building over 39 years, which is going to give us an effective depreciation each year for those 39 years of $20,513. You're a real estate investor. You make a lot of money. You're in the 37% marginal tax rate. So your effective tax savings from this are going to be $7,590. It's going to go directly to your back pocket because, of course, depreciation isn't a real thing. Now, let's say you're making $80,000. Your tax-advantaged income on that asset is now going to be $87,590. We paid $1 million for the building, which means our effective cap rate on that asset with our tax-advantage strategy is going to be an 8.76 cap. Not bad. I believe right now in May of 2023, the market is trading between a 6 and 7 cap. So if you get an 8.76 cap building, I mean, that's a great asset. So now let's use a cost segregation. So you have the same exact building. It's still $100,000 for the building or for the asset, $200,000 for the land, but you were able to separate out the building value into $500,000 building, $100,000 5-year, $100,000 7-year, and $100,000 15-year property. So what is this going to look like at the end of the year when you're filing your taxes? Well, the building's still going to be depreciated over 39 years, giving us $12,821 in depreciation. But because we now have these additional depreciation sections with different schedules, we are able to capture $20,000 in 5-year depreciation, $14,000 in 7-year, and $6,000 in 15-year. So add it all together, this is going to be $53,773 in depreciation expense in year 1. Still Mr. High Earner, still in that 37% marginal tax rate, and now our effective tax savings are going to be $19,896, over double what you were previously getting, nearly triple the amount of savings that you would have had if you didn't do a cost segregation. At the same net income, our tax advantaged income is now going to be nearly $100,000, which it's not difficult math. You guys can all tell this is going to end up giving us about a 10% cap rate on that asset. So now we took an asset that our investors or maybe our principals thought we bought for 8 cap and turned it into a tax advantaged 10. Really impressive stuff, guys. It's really cool, but that is only using straight line. Things get really interesting when we use the 200% declining balance method. So of course, we're still going to have the same building depreciation. We're not accelerating that. You can't use the 200% depreciation method on a building. However, like we talked about earlier, we are now going to take double what we would have taken using straight line, which is going to give us effectively $94,725 in depreciation expense in year 1. So what does this look like for your back pocket, for your bottom line? Well, now you are saving $35,000 directly to your back pocket that you are not paying to Uncle Sam. at that same $80,000 net income, your effective tax advantaged income is now $115,000. Same $1 million purchase price is going to give us an 11.5 cap return. Guys, if you are buying a building that you think is an 8 cap, but in reality you can use a tax advantage strategy to turn it into an 11.5 cap, there is nothing that you can't do in real estate. So as you just saw, cost segregation is pretty sweet. I mean, we just turned an 8 cap return into an 11.5 cap by doing nothing but using smart accounting strategies. Now, it is relatively new and just started gaining significant popularity since a 1999 case between the Hospital Corporation of America and the commissioner. In it, the hospital corporation tried to depreciate different aspects of their buildings, such as security systems, fire alarms, and elevators on these accelerated schedules. And the U.S. tax court ruled that they had provided sufficient evidence to do so. So guys, it is crucial to talk to a CPA, to an accountant, to a lawyer before you do a cost segregation to make sure that you're going about it the right way and classifying the right items within the right years so that you can avoid any legal or financial headaches down the line. But it really is an awesome way to maximize your returns and fully capitalize on your portfolio. Of course, I'll leave some resources down in the description. Leave a comment if you have any questions. And until next time, deuces.